out. My name's Karen Cortez. If you have any, since we are a small group, if you have any questions or specific scenarios or concerns to yourself, please go ahead and drop any questions in the chat. I know Naomi will help me catch those if I miss them, but we definitely can answer specific questions. I'm here mostly to talk about generalities of retirement plan options out there. As you can imagine, there are a lot of laws regarding offering retirement plans to employees, and not all of them are just my agency. So it can get difficult, it may seem, but I'm here to just kind of give you some overviews on some of the benefits to different specific types of plans, and things that you can start to think about as maybe you think about opening one, or if you already have one, maybe some things that you need to think about. Next slide. So just so you know, like I mentioned, multiple agencies govern retirement plans. So my agency governs reporting and disclosure and the fiduciary responsibility. So things like what does the fiduciary, which is the person responsible to make changes, run the plan according to the rules, what are they responsible for? We use words like prudence, best interest of the participants a lot. Those are how the laws are written about the fiduciary responsibilities. But that's specifically my agency. So more particularly, we come in if there are violations to those kind of laws. If there's a piece of a document or a disclosure that is required that is not happening, I would be the one that would call and say, hey, is this happening? It doesn't seem like it, or we've got a report that it isn't. Here's the laws that govern these kind of reports or documents. And also things like deposits, whether it be employer or employee contributions. We govern the laws, some laws that dictate timeliness, and how quickly they have to go in and what has to happen. So then there's the IRS. IRS has different things like discrimination vesting. They have more of the penalty side. So if there are penalties that would have to be, honestly, that's not something my agency really gets into unless you go far down the road with what we call prohibited transactions, not typical in some more of your small employer plans. IRS and DOL, we do work in tandem. I will not say we have communication together very often unless we need to pass something up the chain. But it is something that both sets of laws are in play. And if there's one that might seem more stringent or more strict than another, whatever is the most strict would have to be the one that's followed. And I'll give you the specific example later of where we see that play most often. The last one you see there is the Pension Benefit Guaranty Corporation, the PBGC. This may just be informational for those of you who have pensions or previous pensions. If a company goes bankrupt and they were offering pension benefits to their employees, this is the agency that deals specifically with that. So it is just what we would call those defined benefit plans or pension plans, but that agency is out there. Next slide. So, and even just coming to this kind of meeting, it obviously is something that you may be interested in or already be looking at a way to attract new employees, better employees, keep or retain your great employees that maybe just need something more that may not necessarily need to come in the form of wages. So obviously health benefits, we did a webinar last week. That's one type of incentive, but also offering retirement savings is something that a lot of people, they may not think they want it, but they also, a lot of people aren't going to go out and initiate this themselves. So being with an employer who is willing to at least step in and help them start to save for retirement can be a big plus. And there's quite a few options. And so there are usually something that fits most types of the level of investment that you want to get into. Next slide. So obviously for employers, there hopefully is an attraction to offering retirement plans. Contributions are deductible when they're contributed. There are certain tax breaks and things that allowing you and your employees to grow your money tax-free obviously for a certain amount of time. So it is tax-free as long as you wait a certain amount of time to take it out. Or there are some certain circumstances where they can be, you can take distribution without taxes, depending on those kind of events. But it is something that as an employer, you typically will get a tax deduction for being able to offer that, plus the contributions that you are making into the plan if you do choose to make contributions to your employees' accounts. Next slide. So this, if you have a particular, every company is different, every employer is different, obviously the fields that you're in, the type of employees you have. I will say I most often see groups of generations. So an employer, depending on the type of job business they have, will have maybe an older set of employees. This might make it very attractive to maybe you're 50 and older, that they can make catch-up contributions. That might be a very particular thing of interest for those people who maybe have not yet saved enough for retirement. And then they get this opportunity because they can make higher contributions than other ages of people. You can claim the small employer tax credit. Now, anything tax related is going to be the IRS. So I likely can't answer specific questions to how those affect your taxes, but you can claim some tax credits for setting up certain types of plans, mostly the IRAs and some of the 401ks. And then you can choose, obviously, maybe in the last 15 years, Roth accounts have become much more popular. Typically, they are just another option that when you go to speak to a third-party administrator, or a TPA, as we call them, that those are often now very common additions that you can add on to the plan, whether it be, straight traditional, either 401ks or IRAs, or you could choose to allow for those Roth contributions. Roth being that the money is already taxed when it goes into the account. And so both the money and the earnings grow tax-free. Now, the earnings are not taxed as long as they wait till a certain age to take those out, but the base money that has been contributed has already been taxed. And so this is very attractive to some of those people in the higher brackets that either know they're going to be in a higher bracket as they get older, or maybe just upon retirement, they think they're going to have some kind of inheritance income, maybe a double household income, that they'll be in a higher tax bracket. So they may want to tax themselves now versus taxing themselves later. Next slide. There are types of plans for all businesses. Usually the plan criteria you're going to see written most often is one employee or more. There are some plans that will allow the business owner to be counted as that employee, depending on their kind of how their salary or how they've chosen to pay themselves. So that's something more specific into the tax definitions of what is an owner versus what is a self-employed person versus an owner/employee. But there are types that everyone can fit into of retirement plans. Next slide. And I will tell you, last webinar, I overtalked quite a bit and then got kicked off. So I want to make sure we get through everything, leave plenty of time. And like I said, this is an overview just to kind of get your brain thinking about the different options so that you can go investigate maybe those few that are interesting to you. So the basic types, and these are the terms that you'll hear us use legally, and I'll continue to use them in the webinar. IRA-based plans, individual retirement accounts, IRAs, IRAs, all the same thing. Those are going to be kind of your 401k basic plans. So they look very similar, but because of the differences, things like how you set them up, some of them have mandatory employer contributions. Usually they are a much more basic scenario that you avoid things like your 5,500 tax filing, some of the discrimination testing, and it just stays more simple. Defined contribution plans are going to be your 401ks, your profit sharing plans. So these are the ones that we call them DC plans. Defined contribution is that you're going to have accumulated contributions and earnings. These are going to be participant directed. The participant is always going to have a choice or an opportunity to deposit money into these type of accounts and direct those deposits. And then you have your defined benefit plans. These are your pensions. So we kind of use those words. Most people, obviously, if I say defined benefit, they're like, I've never heard of that retirement plan. So we use the word pension a lot because it is one of the more traditional terms. All of these are retirement benefits. So the defined benefit, that's not going to be something typically a small employer usually chooses to set up. I will say, just because of the funding criteria, this one is obviously something that every person has account deposits into an account, but you are required to fund at a certain level for the number of participants with their expected rates of return in the future. So it is quite a bit more complicated and usually a little bit more administratively costly. Next slide. There are other options out there now. These laws have kind of come, then left, and then come back. There's employer association and professional employer organization retirement plans, or there are pooled employer plans. Now, the difference between the two is, one, basically the first one is going to be your common like employers. So, and it kind of really is the only distinction. So the employer association are going to be like or similar like companies. So all, maybe people in the craft, if they have, they can call themselves either, craft providers or service providers who deal with building or constructing things. Those would be like type employers. They may not have any association legally, but they could decide to come together and run a retirement system. And then they would hire this professional employer organization as part of that business, and they would help administer, monitor the plan, and they can come together usually in the hopes of reducing the fees or the cost to all of those employers that are grouping together. Now, the pooled employer plans, these are unrelated employers with no common interests or organization relationships. So they have nothing in common. So this is your butchers and your street masons, two absolutely unrelated businesses, but could also come together and run a pooled employer plan. Similar, obviously, always in intent and their desire of offering these employer plans, but they are just categorized differently so that they can make sure that they keep those distinct. This is something that is most often set up by the states. So states will have a hand in making sure that they meet the criteria of either the employer organization retirement or the pooled employer plan. And some states will have further laws regarding those. But at least federally, it has been, the law has been passed to allow for that. I won't say in Washington, I know of very many of these, but this is something you can go out and ask to join. So if there's already one very well established, a small employer could go to them and ask to join their already established retirement plan instead of setting up your very own. Next slide. Sorry, I lost there we go. So starting at the most basic, and kind of working our way towards the most complex. I simplified, and just one second. So go back one slide to payroll deduction. So go, yeah, we got way ahead a little bit. So there we go, payroll deduction IRA. So this is not even a formal plan technically, but it is considered something you can offer the employees. So basically you would tell the employees, you can go out and find somewhere you want to set up an IRA, and I will be in charge of the payroll deductions and passing those contributions on to that IRA. It's a way just basically for them to never have to touch the money, not have to set it up on their own. And the employer is merely the electronic pass-along tool. So this is something that if you have a very small business or you have someone that says, hey, I already have an IRA set up, can you just make sure that money comes out of my paycheck? This is a way for the employer to set up and do that. Next slide, please. So a simplified employee pension or a SEP. We call these SEP IRAs, even though they have the word pension in them, we just call these SEP IRAs. So this is something that is only employer contributions. So this is not actually one that the employee is going to put in any percentage, similar to a profit sharing plan where that is also employer contributions, but this is a much a different calculation or a different way to determine how much is put in. So you would have to make a uniform percentage for all eligible employees, but the contribution is not required every year. So basically in the plan documents that have to be set up for this, you do have to determine how that calculation is going to be determined and what kind of criteria, if you want to establish, of when the employer is going to be making those contributions. Similar to all of the plans, every year or two, the IRS changes the contribution limits. And so this one is, I believe as of the last one, the max employer contribution to a SEP for 2022 was the lesser of 25% of their compensation, or 61,000. So this is actually quite generous if you have those assets and you want to be maybe contributing heavily to employees in the plan, but you don't want necessarily, maybe they're not interested in contributing, or you're not interested in letting them have access to diversifying investments and things like that. This one, typically most of the IRAs all are exempt from the 5,500 filing criteria. This is one that you do have to file a form 5305, but that's just at the initiation or taking on the setup of this plan. So make sure that the IRS has on record that this is being established and all the criteria. Next slide, please. The simple IRA. So obviously simplified retirement pension, SEP, sounds very simple sometimes when we just say simple IRA, but they are two very different plans. But these are specific. You must have less than 100 people. Employees can choose to contribute, and this requires employer contributions. So you have an option, but they're kind of very, they're not flexible options. You either pick up to 3% of an employee's pay or a fixed 2% for everyone. So you pick that, and that is how the plan runs. That contribution is always made. It's not optional on any years like the SEP was. And so this one, we'll talk a little bit more about contributions at the end, but the Department of Labor has a criteria for employee contributions to be made for plans with less than 100 people. Contributions coming from the employees must be made as soon as can be segregated from the company's assets, but no more than 7 business days. And I say that very slowly and in distinction, because some people only hear the 7 business days and they're like, oh, super, I've got 7 days. But no, it starts with as soon as can be segregated. So if you can do that in 3 business days, that is the expectation. If you say, well, all I really have to do is, wait for payroll to clear the bank and then I hit that transfer button, that is the expectation. 7 days is what it's called our safe harbor deposit. So basically it's a safe harbor for the participants. It's giving them a safety net that their contributions are going to go in to be making them money in interest. So you will also read that IRS has a requirement, and it is a 30-day requirement. Ours is obviously more strict. So this is one that has to be followed at the 7-day or less. Now I say that because employer contributions are only due once a year, and they're due the following tax year. So technically, if you want to just go off the minimal letter of the law, an employer only has to make contributions once a year for the previous calendar year. And that is due by your tax filing. A lot of employers will be more generous, and they'll just deposit those employer matches or those required contributions at the same time as their employees' contributions are going in, but that is not required. There's a very distinct difference between employee contribution requirements and employer. Next slide, please. And you'll see that across all of the plans. That requirement is not just for these IRA plans. So these are considered the more easy to set up. typically they're lower cost because they're going to come in a bundle. You will go to a TPA, you know, Fidelity, Wells Fargo, Merrill Lynch, and they will have basically, it's kind of like a box that says, hey, we want a SEP. So they'll say, okay, this is how our SEP runs. These are the criteria, you need to set up this thing. And it's going to be basically a low fee type of plan because there's not a lot of options that you're going to be allowed anyways. There's no annual filing, which is often put on the TPAs as well. There's also no loans allowed. So there's not going to be any additional paperwork or criteria of, well, does this person qualify for a loan or not? It's just not available in these plans. So it is much easier to operate typically. But again, it is narrow. There's not going to be a lot of flexibility either if different employees maybe need different options. Next slide, please. So our 401k plans, this is where I'm going to be very similar to IRAs, but you're going to start getting into a little bit more flexibility with a little bit more cost based on that flexibility. So the traditional 401ks, these are something most of us are very familiar with. Around the 90s, they became much more popular. These are, someone can choose to contribute a certain percentage of their wages to go into the 401k. It's typically pre-tax unless you, again, offer that Roth option. And it is something that the employer can choose to make contributions, can choose to just let it be an employee contribution plan. Whatever that choice is going to be, again, on the employer option does have to be in the plan rules. So when we say optional, we mean it's optional for the whole plan, not optional participant by participant. So you can't choose to match one person 3% and choose to match another person 1%. That is not an option. But if the employer says, hey, we're just not going to be involved in the whole matching contribution thing, this is going to be strictly employee option. If they want to put in, they put in. That would be this type of 401k plan. And the employees, you could make, so there's a little bit of option, I think, that not a lot of people choose, partly because it is just easier to let the employee choose their contribution level. But sometimes, for example, some plans don't want to offer half percentages. That's something that some plans can choose. I had that complaint come up the other day that somebody wanted to contribute 3.5% to maximize something that was also in the plan, but the plan only allowed for 3% or 4%. That was what that plan was set up to do, and they can absolutely do that. So it sometimes the flexibilities, once they're established, once you decide how the plan is going to be allowed to run, it does have to run that way. And it's not as flexible as some people think. Next slide, please. So a safe harbor 401k, these are all, the next ones are all just going to be types of 401ks that have slightly different nuances. So this is similar. The safe harbor, though, does require employer contributions. Similar to that simple IRA, this is going to require a type of selection of contribution. So at least you can see the minimum requirements, 100% of the first 3% of their compensation, or 50% of the next 2%, or just a straight 3% for everyone. So it is going to be something that's not an option. But the benefit that comes with this is that you don't have non-discrimination testing. So all the other 401ks that you see are going to have discrimination testing to prove that the employer is not compensating some employees more than others. And so this setting it up to where basically the employer contribution is mandatory and it's going to be chosen and then consistent throughout the entire plan helps you avoid that discrimination testing, which in the end, I mean, it's not bad to have discrimination testing, you just have to pay for it. So this can be a cost that you don't have to incur if you set up something under this safe harbor 401k. Now, we'll talk just a little bit more about the discrimination testing on some of the other plans, but some of the higher paid employees that can afford to contribute maybe a lot more, or that maximum allowed under the law, but they won't be tied to those lower paid employees. So the non-discrimination testing just means that the percentage that the employer has determined they're going to pay is consistent. But if it is based on the percentage that the employee chooses, that's fine. And that's what that testing will prove out. That so if an employer says, hey, we're going to pay 10% of whatever you choose to contribute, the discrimination testing just is a way of saying that this is really what's happening, not that the employer is suddenly putting 15% in, maybe for someone who has higher earnings, or that they're discretionally hiring the percentage for people who do earn higher wages. So this is a way of getting around that. Next slide, please. Automatic enrollment 401ks. This is just exactly what it sounds like, is that you set up in the plan that everyone will be enrolled upon eligibility. Now, you can and will offer them the opportunity to opt out, but as we may all know as employees, and you as having had employees, a lot of people, if they're required to take an action, if they're required to do something, most often or not, they'll just not do it, as long as the consequence is not great. So this is something to encourage enrollment, so that if you just say, hey, if you do nothing, you're going to be signed up and 3% is going to be taken out to put into retirement plan. Some people they'll think, oh, all right. And they'll just move on with their day. And then those that this significantly, if that's something they truly do not want, can't afford, they will have the right to opt out, but they would have to actively do that. And that's sometimes just the act of having to do something is enough to get people at least enrolled in the plan. That increases your plan participation, which usually helps decrease the fees across more participants. And you can negotiate better with those TPAs. If you can say, hey, I can guarantee X amount of people in my plan, they're willing to negotiate fees, or maybe some kind of flexibilities or extra options in the plan for that same cost. Again, on those automatic enrollment, you will also have to spell out, if you are automatically enrolled, what are going to be those automatic default investments that you will be put into. Oftentimes things like a long-term plan. You know, if you don't come in and actively move around your investments, you're automatically going to be put into this low earning long-term plan. Maybe not low, but maybe not as actively aggressive or risky as some of the other plans or investments available. Next slide, please. And then we have our combination safe harbor automatic enrollment plan. Basically just exactly a combination of the last two. The employer does have to make a contribution, and the match is slightly different. So either dollar for dollar. And then there are mandatory contributions, but they can make additional contributions to each employee's account. And they have a flexibility to change that amount. So things like vesting also can be on a graded scale. Things you can impose on this plan a little bit more than you could on the other safe harbor plan. These do not have to do the annual non-discrimination testing, again, because of the safe harbor option of this. They have lower administrative costs than your traditional 401ks because there is no discrimination testing. Unlike the safe harbor 401k that was just strictly safe harbor, the employer contributions on this do not automatically vest. So you can impose a vesting schedule. That is good for you in that if someone just, if someone's just waiting for their time to come and they say, you know what, I'm just waiting for the contribution and then I'm out of here. There can be maybe, hey, you have to work 3 years before you're vested in this contribution. That's something that retains people or helps that maybe you don't make a contribution, and that contribution would actually come back to the employer if it's not vested in. Next slide. The Roth 401k, we talked a little bit about this. This is just making the opportunity for post-tax money or already taxed money to go in in a retirement account. Obviously, this will still be included in their gross income, but distributions are not taxed on that base amount, and the earnings are not taxed if they wait a certain amount of time. Next slide. Another type of what we would call still our DC plans are profit sharing. This is something that the employer basically is all employer contributions, because obviously employees are not going to make profit sharing based contributions, but you set up in the plan rules how the calculation is going to be made. And then you determine, but it does not necessarily mean that that contributions have to be made every year. It is the discretionary contribution. So each year, based on that criteria of the plan, the employer can decide if they're going to be making contributions. It does not have to be directly tied to profits. So that is not necessarily what has to drive your decision to contribute. But the formula for how you determine the contributions does have to be a set formula, something that you say, hey, we're going to base it off of this. It's going to be made this way the same time every time we do decide to make it. And there are limitations on the contributions. 2022, again, this was similar to the SEP, is lesser of 100% of compensation or 61,000 per employee, whichever is lower. So there are IRS limitations on those deposits. And again, usually the IRS is really good about advertising or posting those limitations each year, and they usually go up by a percentage or two every year as inflation also goes up. You can allow loans or directed investments in these. So even though the contributions are going to be all employer, it does then kind of become more of a DC plan in that the participant, once they're vested in the amount, can go in and direct the investments and also apply for loans against those accounts. Because once it's vested, it's their money. It's considered 100% theirs. And so those would typically allow for loans if your plan allows that. Next slide. Things to consider. So DC plan, defined contribution versus the IRA, usually administrative costs are going to be higher on these defined contribution plans because there are going to be a lot more options. Things like loans and withdrawals, early hardship withdrawals, those can be administratively complex. And so the TPA is typically going to charge more for those, but you're going to have usually more investment options, more options for contributions, whether it be employee or employer. And the contribution levels are higher on these plans. So it's just basically fees are higher because there's going to be more options available. These are all plans created. So while you may on some plans avoid things like discrimination testing, 5,500 filing, depending on the type of plan, you still have to have, though, a plan document for all plans available. Basically, you have to have available to your employees what we would call an SPD, similar to a health plan. It's just called a summary plan description, saying who's eligible, when are they eligible, what are the plan rules guiding it, things like are loans allowed, are employer contributions required. All of that has to be laid out in a document given to the employees within 90 days of becoming eligible. So every employee that comes to my agency and says, man, they've been taking money out, but I don't know where it's going. They never send me an account statement. I have no idea what's happening. I say the first thing, do you have your SPD? Have you asked for the plan rules that govern this plan? And they say, oh, I have no idea what you're talking about. That's the first thing we say. Go to your employer and ask for the plan rules. They have to have a document. So that is one of the first things that you have to know that has to be created and available regardless of the type of plan. Next slide, please. Now, defined benefit plans, again, I kind of mentioned the difference, DC versus DB. Defined contributions, much more popular nowadays, partly because these defined benefit plans, which were kind of, king back in the 70s, 80s, early 90s, are very employer administratively burdensome because it is almost all employer money. It is something that provides that fixed benefit upon retirement or upon a certain age. And it has a fixed value. It's not growing based on a market. It's not dropping based on a market, but it is the employer is able to contribute and has a better tax deduction for you because you are likely contributing quite a bit more than you would be to an employee's DC plan. And there are certain funding requirements. So if you set up a plan that says, hey, I want to pay everyone 3% of their highest earning year for the rest of their life, you have to set up that formula. And then upon eligibility, so if someone, says they vesting is 5 years at a minimum, and they come to you 20 years later and say, hey, I'm 65, what's my benefit? You have to hire an actuary to perform that formula calculation and make sure everything is exactly how the plan was set up. So it is a little bit more burdensome in cost. It is a little bit more beneficial sometimes to the employees who really want that security, knowing I'm going to have a fixed income of whatever, of X amount, if I work these many years. So it is highly attractive to people, but it is a high burden or a high risk on the employer to be able to say, okay, I'm going to promise this, but I'm promising this 20 years down the road. And so I'm going to make sure the funding plays out for the future. So it is a little bit more difficult. It is why you see it not being used as often, but the plans that can offer it, it does attract a high level of employee. Next slide. Things that we just mentioned: have to hire the actuary, higher administrative cost, have to always file taxes on these type of plans. Very obviously, again, not so common anymore, but very attractive to employees. Next slide. So obviously, the reason there's so many is that you could, depending on type, size, age, goals. I mean, if you have 2 employees and you can go to each one of them and say, what are you looking for in a retirement plan? What are your goals? You could try and pick one of these options based just on what that actual employee wants. Or you as the employer can say, who do I want to attract? Who do I want to help? What can I do to, which one of these plans fits my ultimate goals as an employer? So you can choose that as an employer, or you can actually maybe discuss with the employees what would be more beneficial. Next slide is just kind of a sum up of all those different options. And actually, we are reaching the end of our slide. So if you want to go to the very last slide, Naomi, just to give those resources out. And then I would like to be able to share a screen of something that we have available online or hard copy, something that I find to be taking all of this together and summing it up very easily. So I will share my screen very quickly. Share this. So this is our publication on choosing retirement solutions for a small business. This, it's about a 6-pager. It's not very long. It kind of talks about the summary of each type, but you have this grid here that gives you IRA-based 401k defined benefit. What is the employer's eligible? What is the employer's role? Who can contribute? What do they have to contribute? So it's super helpful to be able to look at this and just very quickly kind of compare all the plans across one grid and say, okay, does this one require employer contributions? Yes. Does this one allow for non-discrimination testing? No. So you can look at get a very, I enjoy this much more so than maybe the slideshows that you can get from us. And then each one of these options, we have a full publication on. So you can go to back here to our publication site. And just really quick, so we've got a whole set of publications on retirement, but you have a whole right here: payroll deduction IRAs for a small business, profit sharing plans for small business, SEP retirement plans for a small business, simple IRA. You can click on any one of these and be taken to a full publication that fully explains each type. So this one would go down. This is about a 7-page talking about establishing the plan, operating the plan, notifications for the plan. So each one has a much more more information than what I was able to shortly provide in just this webinar. So you can go to each type of these plan and get more specifics. How does it work? Examples. So we have a lot more helpful information than just this brief information. And we're happy to send this out in hard copy. You can obviously go on our website, pull this up, print it out, but we also have copies we're happy to send out if you want to get a selection of them, or just have us send you a few of them. You would just contact me on that resource that she sent out, and I will stop sharing. And so if she wants to pop that back up, but you're welcome to call me directly. We also have an 866 number there on the resource page. Or email me directly is fine as well if you have any questions or any information that you want more information on. That interactive small business advisor also, that is something that you can go in. It is still active on our website. I went and checked. You basically just go and it'll ask you a series of questions to identify what type of employer you are, the size of the workforce you have, and it may help. It kind of helps guide you through what might be a good option for you in that small business advisor. So you can it gives you feedback as you answer some of the questions on the type of employer that you are. Is there any questions for me right now that we can answer before we close up? And you're welcome to use microphone or chat either way if you have any questions. Or again, you can reach out to me personally if you have any questions. But that is all I have for you.
Thank you so much, Karen, and thanks for everyone who joined us today. We did record, so we'll have the recording available on the website. And if you have any questions, please reach out to us. And if you'd like to connect or get any of the resources that Karen provided, we can get those to you as well. Hope everyone has a great afternoon.
Thank you.